You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Hello, and welcome to HECM World Weekly. I'm Gabrielle Hayen. This week, concerns around reverse mortgage sustainability, retirement income pressure, and the future of home equity planning all moved further into the spotlight. A new HUD audit has warned more than 1,200 reverse mortgage borrowers could face heightened default risk due to rising taxes and insurance costs. Illinois has introduced one of the nation's most comprehensive regulatory frameworks for home equity investments. New retirement research shows retirees without guaranteed income are rapidly depleting assets, and growing capital gains exposure is increasingly trapping older homeowners in place. We'll break it all down in this week's HECM World Weekly. We're starting with the story that has been raising concerns across the reverse mortgage industry. A recently released audit by the HUD Office of Inspector General has warned that more than 1,200 reverse mortgage borrowers may be at heightened risk of default because funds set aside for property taxes and insurance could run out years earlier than projected. The issue centers around life expectancy set-aside accounts, essentially escrow-like reserves used within certain HECM loans to help financially vulnerable borrowers cover taxes and insurance over time. According to the audit, rising homeowners insurance premiums and escalating property taxes are significantly outpacing the assumptions built into those calculations. The report warned the issue could expose the Federal Housing Administration to as much as $258 million in losses if affected borrowers default. The audit also criticized HUD for failing to adequately test whether these accounts would realistically last throughout the borrower's lifetimes, particularly in today's rapidly changing cost environment. Importantly for the industry, the National Reverse Mortgage Lenders Association announced it will form a task force to address the issue. Now, while the numbers involved are relatively small compared to the broader HECM portfolio, the story highlights something much bigger happening across retirement and housing generally. For many older Americans, it's no longer just the mortgage itself creating pressure. It's the ongoing cost of owning a home. Taxes, insurance, maintenance, and inflation are all becoming increasingly significant retirement risks. And for reverse mortgage professionals, this reinforces the growing importance of long-term planning, conservative projections, and ongoing borrower education around sustainable cash flow. Next this week, Illinois finalized what industry groups are calling one of the most comprehensive regulatory frameworks in the country for shared equity products and home equity investments, often referred to as HEIs. The framework was adopted under the Illinois Residential Mortgage License Act, following collaboration between regulators and industry stakeholders. The rules establish detailed operating standards for shared appreciation agreements, including tailored ability to repay alternatives, disclosure requirements, and a new cost-focused disclosure form specifically designed for these products. The Coalition for Home Equity Partnerships says the move could become a model for broader national regulation. Now, this matters because home equity investment products continue growing rapidly as alternatives to traditional lending and reverse mortgages. These products typically allow homeowners to access equity in exchange for a share of future home appreciation rather than taking on monthly loan payments. For the reverse mortgage industry, the broader significance is clear. Home equity itself is becoming a much bigger conversation across the financial system. As more companies, investors, and regulators move into this space, the importance of transparency, consumer education, and product positioning is only going to increase. Turning now to retirement policy. A new analysis from the Center for Retirement Research at Boston College raised concerns this week about a bipartisan proposal designed to stabilize Social Security by borrowing borrowing trillions of dollars and investing the proceeds into the stock market. The proposal, backed by Senators Bill Cassidy and Tim Kaine, would involve borrowing around $26.6 trillion over 75 years, including an initial investment fund of approximately $1.5 trillion. The idea is that long-term market returns would help support Social Security solvency, but researchers warned the strategy is unlikely to work on its own. According to the report, the most likely outcome would still leave taxpayers with substantial debt exposure, even under relatively optimistic market return assumptions. The analysis concluded that equity investments might assist Social Security finances, but only if paired with tax increases or benefit reforms. The report also warned that the window for implementing these kinds of strategies may be closing quickly. For the reverse mortgage industry, this continues reinforcing an important broader trend. Retirement income uncertainty is growing, and as confidence around traditional retirement systems weakens, home equity is increasingly becoming part of the conversation around retirement sustainability. Another major retirement story came from the Employee Benefit Research Institute. The organization released new research showing retirees without guaranteed income streams are depleting assets dramatically faster over retirement. The study tracked household assets over roughly 3 decades using data from the Health and Retirement Study between 1992 and 2022. And one of the standout findings was this: lower asset retirees without reliable guaranteed income saw median assets decline by roughly 89% over 21 to 22 years of retirement. By comparison, retirees with pension income generally preserved wealth far more effectively. The broader takeaway is significant. Retirement success increasingly depends not simply on how much wealth someone has, but on how reliable and sustainable their income streams are. The report also noted future retirees may face even greater challenges because traditional pensions continue disappearing. Most Americans are now entering retirement with 401ks, IRAs, Social Security, and home equity, rather than guaranteed pension income. And that's where the reverse mortgage conversation becomes especially relevant. The research strengthens the argument that reverse mortgages, particularly HECM lines of credit and 10-year payment structures, can play an important role in retirement income planning and asset preservation. Rather than forcing retirees to liquidate investments during poor market conditions, housing wealth can potentially provide flexibility and liquidity later in life. And increasingly, that's how many financial planners are beginning to frame the conversation. Meanwhile, new research from the National Association of Realtors highlighted the growing problem of capital gains exposure among longtime homeowners. Now, this issue has been building for years. Federal capital gains exclusion limits for primary residences haven't changed since 1997, despite U.S. home prices more than tripling during that time. And according to the latest analysis, around 63% of homeowner households in San Jose now exceed applicable exclusion thresholds, more than 54% in Honolulu and about 54% in San Diego. What's particularly notable is that the issue is now spreading beyond traditional high-cost markets into fast-growing boomtown areas. And this is creating what many analysts describe as a lock-in effect, where older homeowners become increasingly reluctant to sell because of potential tax exposure. For the reverse mortgage industry, this is another major aging-in-place dynamic. If retirees become less willing to sell homes due to taxes, many may instead look for ways to access equity while remaining in place, which again pushes housing wealth and reverse mortgage strategy further into mainstream retirement planning discussion. And finally, this week, Wells Fargo agreed to establish a $100 million mortgage assistance fund as a part of a broader $110 million legal settlement. The lawsuit alleged the bank approved less than half of Black homeowners' refinancing applications in 2020 and also accused the company of conducting sham interviews with non-white candidates to appear compliant with diversity hiring goals. Under the settlement, Wells Fargo will create a borrower assistance program focused on supporting low and moderate income borrowers in communities disproportionately affected by lending barriers. The program originally covered 32 metropolitan areas, but has since expanded to more than 50 communities nationwide. The broader takeaway here is that fair lending, borrower access, and housing affordability continue to remain major priorities across the mortgage industry. When you step back, this week's stories all point in a similar direction. Retirement pressure is growing, income stability is becoming more important, and housing wealth is increasingly moving to the center of retirement strategy conversations. Whether it's rising taxes and insurance, Social Security uncertainty, disappearing pensions, or growing capital gains exposure, older Americans are navigating a far more complex retirement environment than previous generations. And that places reverse mortgage professionals in an increasingly important position, not simply as product specialists, but as educators, strategists, and guides. For more industry news, insights, and analysis, visit HECMworld.com. I'm Gabrielle Hayen, and we'll see you next week on HECM World Weekly.